just lay out the agenda for today very briefly. We'll go around quickly and do a round of introductions so that you can hear from each of the panelists. Then after we do the introductions, we'll be going through and hearing from each of the individual panelists about what information they've got to share for you today. And we've got a lot of great information, lots of tips. We're going to be hearing about a study that is hot off the presses about the challenges that women business owners in particular go through with financing. But you know, there's a lot here for everyone, whether you're a man or a woman. So we hope to give you a listen today. We are going to allow 15 minutes at least at the end for questions and answers. So please stay tuned, and at the end, be sure to you can type them in the little chat box. We'll pick up your questions and make sure we answer your questions about financing or about anything that anyone says today. So with that, I'd like to jump into the introduction. So first I'm going to say just a few words about me. I'm the founder and CEO of Small Business Trends. We're an online community, and Public focuses 100% on small businesses and giving advice and information that you need to run your business more effectively, more profitably, and even I'd like to go around at this point, and I'd like to have each of our panelists introduce themselves. So first, Lisa Cook, economist. Tell us a little.
Hi, I'm Lisa Cook, and I serve at Michigan State University in Economics and International Relations. And I have studied small business finance for quite some time, including from my dissertation, although I studied small businesses in Russia at the time. But since then, at the Council of Economic Advisors in 2011-2012 at the White House, I was the person who liaised with the SBA, and I was the person who covered entrepreneurship, small businesses, and small business finance. So I'm excited to talk to you today.
Well, thank you, Lisa. That's very helpful. And I'd like to, at this point, ask Minerva Cote to introduce herself. Her name is not appearing on here, but you'll see her.
Thank you, Anita. Hello, everyone. My name is Minerva Cote. I work with the SME Finance Forum and Women's Finance Hub, which is managed by the IFC. I work as a financial specialist. I've been working with IFC, focusing on access to finance for women and working with financial institutions, preparing them to finance women-owned SMEs like yourselves. I've worked on a broad range of financial assignments in various regions, including East Asia and the Pacific, Sub-Saharan Africa, and in South Asia. Thank you.
And I'd like to ask now Rohit Arora, the CEO of the phenomenal funding platform Biz2Credit, to jump on and introduce yourself, Rohit.
Yeah, thanks, Anita. So I'm Rohit. I'm, as Anita said, I'm the co-founder and CEO of Biz2Credit. We at Biz2Credit help small businesses, including startups, get access to credit from more than 1,200 lenders across the U.S. and funded more than $1 billion to more than 12,000 businesses. And this year we are targeting to fund another $1 billion. So if anybody is looking for any advice, we provide with free loan consultation, a lot of free advice, educational webinars like these, and also actual money. So if anybody is looking for any kind of money, they can come to biz2credit.com and we can help them.
Thank you, Rohit. And last but certainly not least, I'd like to have John Meyer, the Director of Education of the Company Corporation, introduce yourself, John.
Thanks, Anita, and welcome everyone to today's session. My name is John Meyer. as Anita said, and I work for the Company Corporation. We're one of the leaders in helping entrepreneurs and small business owners get their business started by forming a business entity, so either setting up a corporation or a limited liability company, and then we help them with the ongoing compliance of making sure that that entity stays strong and secure. So happy to be here with the rest as well with you, Anita. Thank you.
Well, thank you all. That's a terrific panel here, and I really appreciate you all spending your time. Today's point is jump in to the to what we need to do next. So at this point, I'm going to call again on Lisa Cook, economist, to talk a little bit about what it is that women-owned businesses contribute to the economy, as well as what we need to know and some tips. So what I'd like to ask you all to do as panelists as well is when I need to move forward on a screen, just tell me to advance the slide, and I'll be happy to advance the slide to make sure we stay exactly on point the way you want to stay on point. So with that.
Okay, so I was just going to say that the contact, can you hear me? I hear an echo.
Yeah, I'm hearing an echo. I wonder if you're on the speakerphone or.
I'm not on speakerphone. So I'll just press ahead then.
Yes, go right ahead. Well, I can still hear you.
Okay. So, so one of the things that I said I would talk about on Twitter is differences in credit score. So this is this is related to the presentation that Rohit will be making. But one thing that we know is that women and men behave differently with respect to credit. It's somewhat counterintuitive, and I wanted to talk about sort of the statistical evidence that we have with respect to women and access to credit. So just to summarize sort of what we know from the surveys of small business finances within a span of 16 years, we noticed that women, female and male-owned firms look slightly different. For female-owned firms, they're slightly smaller by sales, assets, and employment. They're younger, measured by the age of firm. They're more likely to be organized as proprietorships and less as corporations. They're more likely to be in retail trade and business services and less likely to be in construction, secondary manufacturing, and wholesale trade. And they are inclined to have had fewer, shorter banking relationships. So one of the things that is intuitive, or that we typically think is that, or that we know, is that women typically have at least slightly lower credit scores than men do. But when you put that in a multivariate setting, when you execute regression analysis, we know that these differences are insignificant when you take into account other firm and owner characteristics. So they turn out to be fairly similar. But there are two ways in which women and men are different. Women are more likely to be discouraged from applying for credit. So they are not more likely, but they're not more likely to be denied credit when they actually do apply. So that's where some of the differences come from. But again, in a multivariate setting, that's not significant. The other thing is that when you look at the breakdown of what kind of credit women and men have, and when they pay credit, it turns out that men have more mortgage debt than women, and this means that they, and as you probably know, many startups get started through mortgage and home equity loans. So men have a greater capacity, financial capacity, because of these larger loans, to start startups. So that's one place in which, and this is a significant difference. This is a much larger difference in the studies that I've looked at that use, say, the survey of small business finances, didn't look at mortgage debt in this way. So this is kind of new, but I think it could explain why we do not see as many larger firms started or owned by women. But we do see, one thing we do see is that when women have a larger, well, let me put it a slightly different way, women don't have as much credit, but they typically pay, they don't pay as many late payments. So for every category of debt, men seem to pay later than women do, or have more late payments than women do. But anyway, I think that that's where also we could talk about macro credit conditions, Anita, if you'd like, but let me leave it there for the time being.
Thank you, Lisa. We'll be getting to specific questions for you a little bit later, and you know, I think that's a good overview at this point of some of the. So with that, I'd like to move on to our next panelist. And let's see, our next panelist, John Meyer.
Thanks, Anita. Well, everyone, I want to go ahead and talk through a little bit about forming a business entity. And if we can go to the next slide here and talk about choosing the right format. So Lisa just talked about some of the economic trends that are going on with women business owners and access to credit and being able to fund those businesses. What I want to talk about is how a woman or a man goes out and creates their own business, and that business is a structure that you're going to be setting up, and you have a couple different options when you choose to start your own business. The easiest is really to go out and be a sole proprietorship, and a lot of folks will use this as a way to test a business, maybe get out there and start testing an idea and see if they can get traction, and then they form their business entity. But a sole proprietorship, it means that an owner typically goes out, gets a business license from their local jurisdiction, so maybe their state, county, or city, and they go ahead and file that business license. It's easy to form a sole proprietorship and then operate it. The main drawback, though, is that the owner remains personally liable for any lawsuits filed against that business. So it's a great way to go out and test an idea, but it also leaves any of your personal assets potentially exposed to any of your business activities that you're doing. But it's a great way to go ahead and just start and test an idea, and a lot of folks will go out and operate. And this really has to do, as you're starting to talk through business credit and funding, is that you're going to form a business entity. And what forming a business entity means is that you're putting a brick wall between your business and your personal assets. So you're creating a separate identity, if you will, a separate entity beyond yourself. So as an individual, you have a Social Security number that is your tax ID number, and you're as setting up an LLC or a corporation, you're actually going to form a legal entity at your state level, and then you're going to get a tax ID number for that entity. So it's looked at as its own separate legal structure that's separate from their owner. The big thing here is that it helps you separate your personal assets from your business liabilities or your debts there. There are certain tax advantages of a corporation, so certainly want to consider. And if you want to go ahead and advance to the next slide there. And when we look at choosing the right structure, you're looking at putting that brick wall between your personal and your business assets. So you're creating that structure, and a lot of people will say, well, why would you want to incorporate? And you have several different benefits when you're thinking about incorporating. The biggest one is your personal asset protection. So think about if you're a woman business owner or a male business owner. We have a lot of folks that are coming to incorporate that business entity, and when we look at their age demographics, they tend to be between 40 and 50 years old, which is going to indicate to me that that individual has had probably about 12 work experience. Well, if you think about that, over 20 years, you probably have accumulated some type of retirement account, maybe a 401k or an IRA. You may, at a point in time, you may own your own car. You may have, let's say, a brokerage account or some type of savings. All of those are personal assets, and you want to make sure that those are separate from your business assets. So by incorporating, you put that brick wall between that. Now, your next piece of that is that when you do incorporate, you do want to make sure that you're setting up your own business checking. The main things that you want to do is have all those financial accounts that you would for yourself as an individual. You also have those for your business. So maybe a checking account or a savings account, a credit card, and Rohit will talk to you a little bit about funding and loans that you might get for your business. But a couple other things that, a couple other benefits that you would get from incorporating is ability and name protection. So by getting a business entity, you reserve the name at that state level. So you have the right to do business under that name, like Biz2Credit. Rohit has the right to do business under that name. Now, additional credibility, a lot of people, if you're working with, let's say, a larger company or trying to gain business from them, by having an Inc. or an LLC, that may give you additional credibility. It may also be one of the requirements that that business has to contract with you. So I just talked to somebody this morning, they contract from probably a Fortune 20 company. Well, that company only wants to contract with another business entity. They don't want to contract with the sole proprietor. So this person that form an LLC and get an EIN or an employer identification number from the IRS, and they need to do that quickly so they can earn that contract from that Fortune 20 business. Benefits that you would get is perpetual existence. So corporations and LLCs, they continue long after ownership or management changes. So think about it as a sole proprietor, or that activity or that business actually ends if the owner dies or if they leave the business. A corporation or an LLC, you could pass it down if you have a family business down to a child or a niece or nephew or something like that, a grandson. You can go ahead and pass that entity, the control of that entity, down. Also, if you think about an exit strategy, like you may want to sell your business in 5 years, you have the opportunity because you have that structure set up with the entity. Go to the next slide. I just want to cover a couple more quick benefits here. Also, some of the benefits of incorporating would be you may have some tax flexibility. So an LLC is taxed at the same rate as a sole proprietorship, but it does provide you that limited exposure to personal liability. So with an LLC, you would have, if you're a single LLC, so there's one owner, you would actually pass any profit or loss to your individual tax returns. So you're only filing your individual tax returns. Now, your other benefit, that deductible expenses, so you might, both corporations and LLCs may deduct normal business expenses, including salaries, before they allocate income to owners. So cover some of the quick highlights of forming a business entity. Obviously, for financing, A lot of the banks will look for a business entity to get that structure set up. There's a lot of benefits of having a business entity. We find that a lot of people that might have a hobby or might be involved in an art, when they treat that in a more serious fashion by incorporating, they tend to have more success as they're putting more focus on their business and are treating it like instead of an art, they're treating it as a business. And another thing to keep in mind, if you are, I mentioned financing and loans, if you're looking at possibly getting some type of venture funding or taking on investors onto a bid for some type of business structure, so either an LLC or a corporation for that. So I'll be back later during today's session, but I'm happy to join the session here and answer any questions about how to incorporate and the benefits of an LLC or a corporation. So with that, I'll turn it back over to Anita.
Thank you very much, John. That was a very succinct and good description of the benefits of that. All right, at this point, we're going to invite Minerva Cote back to talk about women's finance. So Minerva, take it away. And again, just tell me when to advance a slide if I'm not moving fast enough.
Sure. Thank you, Anita. Next slide, please. Yes, so I wanted to introduce to you the Women's Finance Hub. A platform has been established by the G20 and is being managed by IFC. And the aim is to promote and highlight successful business models in finance-owned SMEs in particular. So the hub aims to facilitate collaboration amongst financial institutions and development partners, and we also aim research and data. We also have an active LinkedIn group, SME Finance Forum, where we share experience. The community gets together to have interesting discussions. So I encourage all of you to join our LinkedIn group as well, but also visit the hub and see what is being countries and what could be useful to you, and also obtain knowledge of what is happening in the market. As I said, our main aim is to inclusion for women-owned SMEs, and IFC and McKinsey commissioned a report to assess the financing gaps for women-owned. Next slide, please. And based on this report, we found an estimated 260 to 320 billion financing gap in markets for women-owned SMEs. So what does this mean for women entrepreneurs? What it means is the banks and financial institutions to finance women entrepreneurs, and the issue is, for the entrepreneur, how are you preparing your business for financing? Because when we work with finance, a lot of them appreciate the business case for financing women-owned SMEs. Evidence shows are more profitable, women are better loan repayers, and financial institutions are looking for bankable women entrepreneurs. But on the demand side, they don't find good women entrepreneurs to invest in. So the message here is, how are you positioning your business for financing? I think the previous speaker spoke about legal issues incorporating your company, and which are very good fundamental issues. But beyond that, do you understand the financial products that are there? You cannot start in capital, for example. And do you have matching equity based on the amounts you need? Do you have a good business plan? Do you have strategy? So what I'm leaving with you is, how are you positioning your business for financing? Not only financing, but also financing the growth of your business. Can you manage the growth? Do you have qualified expertise? Have you built the capacity to manage the growth and that you want to obtain? So I will stop here and then take half after this. Thank you.
Thank you, Minerva. That was very helpful, and I'm sure we'll have questions in a bit. At this point, I would now like to invite Rohit Arora of Biz2Credit to come back and tell us about financing options and also about the study that recently was carried out by Biz2Credit.
Yeah, so as I introduced myself, so Biz2Credit is a online lending marketplace, and what we have been doing over the last now 2.5 years is that we started incentivizing and also communicating and messaging to women entrepreneurs that if they identify themselves as women entrepreneurs upfront, we can do 3 things for them. We can get more prepared for loans, because as John Meyer rightly said, you have to have your company in place, you have to have your other legal documents in place. So we said we can help you with business plans, we can help you with more loan consultation. And by doing that, we also said that we will also be able to collect a lot of data on both men and women-owned businesses. And then over a period of time, our aim was we should be able to actually look from a credit perspective angle and see that what are the differences between the men and the women-owned businesses, and also in which direction the women are progressing from a period where there was a great recession in U.S. to a period now where the credit availability is getting better, and our women going to get benefited because of that. So it talks about the challenges which are there for all small business owners in this country and across the world, because there's so many banks and how to find them, and there's a lot of paperwork and there's row, and one has to move from a bank to bank. And in case of women businesses, we have found that to be an even more acute problem, because when they initially come in for getting any kind of financing experience in taking formal financing, or their networks don't have that kind of experience. So we have found that by helping them up front, looking at whether they are incorporated, whether they have a right business plan, the need for how much money even they need for, is actually half of the battle. And then the rest of the battle is that what is the best product and what level of paperwork that they need. You can just jump into the next slide. Yeah. So this is what we do really well, and what we have done is that we have made it free for the business owners to use the platform, and they have their own dashboards, and they have their doc vaults, and they can get all third-party data. We also have a partnership with CSC where we give discounts on incorporating your company or having all your company legal documentation in place and stuff. And on the banking side, we work with large number of lending institutions in this country, including some of the major ones like TD Bank and Citibank and Union Bank, RBS Citizens, while we also work with a lot of micro lenders like Axion USA, which is the largest micro lender in the country, as well as alternative lenders. And what we have done is that we have said that one single application, we have digitized it. There's no need to pull your credit multiple times, and we will guide you through the whole process, because we are not selling any leads to anyone, and we also give a scorecard on their business, which they can monitor it, and they can also benchmark their businesses with other businesses. So that's very important. It's not just about credit. It's about being fully prepared about how to being more credit worthy, because if you're credit worthy, you will get the credit. If you're prepared, you will get the credit. If you know that you need a money for a specific purpose and you can do it, you will get it. So this is what we do. Multiple loan options come in. And the reason I'm just walking through this, and I will just jump into the study after this, is by collect a lot of data. And this data, then we actually, the next slide is actually very important. So now what we have done is that we have been mapping the women-owned businesses for last almost 2.5 years, and we are seeing some phenomena is that in 2012 we had 1,500 plus applicants who completed a full business application, who went through the whole process to get a loan, and that number has doubled of women-owned businesses. So really mean. So that means 2 or 3 things. So if you can just go on the next slide. So one of the things that we are starting to see now is that the average age, because age is one important aspects when you are trying to get loans, because if you have some historical financial data, you will be able to get access to cheaper credit. If you have less historical performance data, you will be forced to borrow money. But at the same point of time, if you don't borrow money too late in your business cycle, then you don't set up a business credit. And if you don't set up a business credit, as John Meyer was saying, first of all, you need to have a business entity. You have to treat it like the way that you treat your personal credit. And once you build up a business credit, then the business should be able to get money on its own credibility and not on your personal credibility. And this is a very development that we are seeing in 2013, where what has happened is that, we are seeing that more women-owned businesses are starting to apply for credit much easier, which means that they are getting more confident, which means they are getting more educated, which means that they're starting to look for outside credit much earlier in their life cycle, which helps them to business credit, and that means that they can grow faster than if they are being undercapitalized, then it takes more time for them to grow. So if we go on to the slide, so the other good thing which has happened is that, and in this country, credit scores matters a lot, even in small business lending. And one of the key things that we have seen in 2000, the average credit score of the women-owned businesses who are coming on our platform has jumped from 592 to 610. So while it looks like a 18-point jump, and people will say it's not a big deal, the big you as a business owner have a credit score of below 600, you are not going to get money from a banking institution or from SBA, which is Small Business Administration, and even micro lenders of more or less 600. So 600 becomes like a threshold where, it opens up a lot more opportunities for businesses to get a true business credit high cost money. And this also helps you that as you keep getting a bank loan or an SBA loan to start building your business credit history and performance, which means that if you're performing well and repaying well, you will start getting more access to credit much more quickly and at better pricing going forward. So this is a very good development, and this also shows that as the economy is improving, women-owned businesses are actually performing very, very well, because compared to men-owned businesses, the jump in the average credit score of the women-owned businesses has been higher. And that is something which we are going to capture on the next slide, the gross operating margins. So we are starting to see that, women are entering into businesses which are service-oriented, which are asset-light. So the good news is that their operating margins are going up, and this is a big jump. And one reason that we are more educated women are joining the entrepreneurship stream in this country. They are starting businesses where they're using more of their skill sets, less capital-intensive businesses, and they're starting to earn, especially in businesses which are more knowledge-driven. So that's a good news. At least from an operating margin, because one of the key metrics for being credit worthy is that how you have managed your operating margins. And the other thing is that if more women businesses start getting cheaper credit earlier in their life cycle, we are seeing a higher multiplier effect on their operating margins. So which is aspect of the study. Let's go to the next slide. And the approval rates still, unfortunately, for the women-owned businesses compared to men-owned is actually less. And one reason is because the average age of still the women businesses who apply through our platform or overall in this country is still less than the men-owned business. Overall size is also less. So it's not just a question of your operating margins or your age. It's also relative to other businesses in your industry, and also revenue thresholds also play. Most of the lenders in this country traditionally less than $150,000 to $100,000. So you need to have certain revenue in order to afford or become eligible. So that's one thing which is holding back the approval rates for women. But I think the way the women businesses are growing in next year or two, my take is that this approval rate will get bridged because we're already seeing that the approval rate difference has gone down from 2012 to 2013. We can go on to the next slide. And so this is what I was talking about. The younger your company is, when you're applying for credit, the faster you will be able to set up your business credit. The sooner you incorporate your company, if you keep your company active on your Secretary of State ability and credit history. And the good news is that as women-owned companies are outpacing men or male-owned companies, is that if they keep growing, this whole approval gap and the revenue gap will also start dropping pretty quickly going forward. We can go on the next slide. So, in this slide, we really talk about what are the causes. So as I mentioned earlier, there are three things, and Minerva also mentioned it. We have seen women are more responsible with credit. So once they get credit, they have a lower default rate. The second thing that we are seeing is women are, in last 10 years, as Lisa said, more women are graduating from colleges and they're using more technology. They're getting into more knowledge-based businesses. And US is now a knowledge-based economy. So if you are in a knowledge-based business, you will grow faster. You will have less fixed cost, and you will be able to actually lower your overall startup cost, which is very important because earlier a lot of women-owned businesses were not able to get off the ground because they didn't have enough money to start a business. And as more educated women workforce graduates from service jobs to becoming entrepreneurs, they are having higher amount of savings which they are using to open and run their businesses. And by doing that, and by not having to borrow very high cost money, they're improving, which means that they are getting more eligible for traditional bank financing much earlier in their life cycle. So that's all pretty good news that that is actually coming better. The second thing is to credit in 2013 has been much better than in 2012. So that has also helped a lot of women-owned businesses to get at it, both under SBA programs and non-SBA programs, and to keep growing faster than the male-owned businesses. We can go on the next slide.
Okay.
Yeah. So we analyzed over 10,000 businesses all across the country and in all states, and we have also released study by every state. So if anybody is interested in a particular state, they can email us at info@biz2credit.com, and we can give them the data for their particular state if they're looking for that, and they can map it back to the national data also. In next two slides, we two success stories. One is from we can go on the next slide. So this is very interesting. So this lady is college educated, and she came to us for the first time in 2009 in the depth of the recession. She was able to get an SBA loan, and then she has come again because now she has opened up 2 more, Sweet and Sassy. And this is a great example of somebody who went on her own and couldn't get money from anywhere, and then got money through Biz2Credit through a local bank which was just 3 miles away from her home. And now she has expanded 2 more stores, and she has grown her business and she has really shown that if you can do the hard work, and then if you can get access to credit, you can really do well. And the next slide is talking about another business, for somebody who's such a recent immigrant into this country, had language issues, couldn't speak English much or understand, and she had approached multiple banks, couldn't get anything. And there is that women-owned businesses or immigrants are less internet savvy, and that's not the case as we see every day. And she got her money for a business that she runs from her home, and now she is taking it forward from there. So these are 2 great examples of somebody who started a business in the depth of the recession, and somebody who came 4 years back and got her first loan in 2000. Now she's growing her business, and she's getting for another loan, and also expanding her and now moving into a commercial space and opening up a retail store also from being a home-based business. So I think this is where I finish it, and we can, Anita, you can handle it from here.
Okay, well, that was excellent. Thank you very much. A lot to delve into there, and I know we've got a lot of questions. Now, just a couple of thoughts about questions. First of all, you can insert questions box on your webinar screen. You just, question box control panel pushed in, you just hit the little red arrow, push it out, and you'll see a little chat box. You can insert your questions. Also, people are submitting questions on Twitter to my handle at SmallBizTrends. Feel free to do that. I've got a lot of questions here, so I'm just going to dig in, and I'm going to start asking the questions of different panelists. So the first question, and that is, the credit scores of men and women differ. Why do they differ so much? And while you're thinking about that, Lisa, I'm going to jump back to one of the earlier slides, if you will, and see if we can find the slide that mentioned that. So we have, here are the credit scores of women showing the credits have improved. And we see that women-owned business approval rates are improving as well here. But Lisa, what is the reason for the difference, and what should we take away from that?
So I would prefer us to do an American Association of University Women study. And this is, again, I get an, do you hear an echo?
I'm hearing an echo, but we can hear you, but there is an echo.
Yeah, there's an echo, Lisa.
So if you, on your computer, that would be great.
Yeah, it's off. So okay. So let me plow through, and if it continues, then I'll try something else. So what we find is that men typically carry 4.3% more debt than women, and much of this debt comes from men having larger mortgages, as I said before. But what we find, surprisingly, is that men and women have almost identical average credit scores. So for women, it's 675. So this is in a study. This is going to vary a little bit from the data that Rohit is presenting because it's over a period, and this is from Experian, a new report from Experian. And women have scores 5 and men 674. And they use almost the same amount of their available credit. And women are all debt. An average man has about $26,227 in debt from credit cards, personal loans, and auto loans, compared to $95 on average for women. But again, mortgages turn out to be the big difference. So with respect to women, men have on average $187,245, and women typically have about $178. So that's a big difference. And with respect to financing, especially startups, this can make a really big difference. So the kinds of dynamics that Rohit was getting off the ground, growing faster, and initial starting point mattering a lot. Because if you can start off with, let's say, $10,000 more dollars, if these are, so here I am equating home equity loans to mortgages, and assuming that one can take money out of that, and this is a traditional way that many businesses, small businesses, have gotten started. That means that there are at least $10,000 more, roughly $10,000 more capacity that men have from the beginning with these larger mortgages. So I don't want to overstate the case, but I'm just suggesting that that could be a large initial difference that could carry over into the growth and development of the firm.
Okay. So very interesting. So now I've got a follow-on question here for Minerva Cote. Now, Minerva, when you spoke, you mentioned how the women have challenges in businesses for financing, such as getting business plans together and so on. What is the #1 mistake that you see that women make, women business owners make, to not positioning their businesses properly? In other words, what do they need to do? What's that one thing, if they could only focus on one thing, what should they focus on first?
Thank you, Anita. What women need to focus on is having adequate equity in their business. So basically, your own stake in the business should prove to the financier that you're serious about what you're doing. Now, if you have confidence in your business, you don't expect someone else to put in more. And the banks always look at what they call leverage. No one wants to put in more money in a business than the financiers have. If you have a business, understand how much do I have of my personal money that I can do it. If I don't have enough, you need to get equity investors. So find out, how can I sell my business to someone who bring in an additional funds to create enough leverage funds to finance in the business. And that's why I added the point, understand the products you are applying for. We have working capital, we have equity financing. You should understand what you're applying for. So you don't expect your financial institution to put in too much more money than you are. It puts every financier off. So having adequate capital is a key indicator to a financial institution that you have enough to put in as much money or more than they are.
Okay, very good, very good. So I want to jump to Rohit at this point. So Rohit, the question here is that you mentioned how business age, the age of the business, is one of the most important factors but you also mentioned this dichotomy between wanting to apply early enough that you can grow your business, but the earlier you apply, typically the less credit. So how should you balance that? And is there an ideal at which you should be applying for a credit to grow a business, or does it vary by individual situation?
Yeah, so I think that's a very good question. So one thing is, when anybody starts a business, they should start thinking about having a plan to establish their business credit from day one. That includes incorporating a company, that includes putting up a domain name, because one should just name a company looking first, that's very important. It should not be taken by somebody else. Then the ideal age to apply for a loan is actually, there are 3 thresholds. So one is, once if you're as an operation, even a home-based business, so one can start even from home. So there's no need to rent a very expensive place, storefront, or an office, because nobody gets impressed with the office, they get impressed with your performance. At 6 months, there are micro lenders like Axion and other micro lenders who can actually help you to give some money. That money might be small because they typically lend between 5 to 25,000. Like personal credit, if you can get some money and you're paying that back on time, and these are typically 3 to 5 year loans, it actually establishes your business credit. Then the second threshold is actually 1 year, 12 months, 14 months, once you have filed your first income tax returns. So that's a big landmark, because once you have filed your tax returns, it clearly means that you have a third-party verifiable document which is as a business owner to show to the prospective lenders that what kind of money you are making and what kind of money you can afford. And by then you will have enough experience also if you have any seasonality in the business, if the demand goes up and down, and what kind of expenses you have. And then the third threshold is when you turn 2 years in business. Because that's a very important threshold. Typical banks in this country will start lending you money when you're 2 years in business. So that is like a standalone money on your business as a working capital or as a term loan, but that comes in of your personal financials. People will be surprised that we fund a lot of businesses with bank loans, even if their personal credit is 600, 620. But if their business is doing well, banks will still fund them if they have at least 2 years of good financial history. So I think those are the three different points or thresholds that a business owner has to plan, and has to plan early. Because if you don't plan early, and a lot of businesses make that mistake, then by the time they are in that stage, they are not really prepared. And as Minerva said rightly, they should know what kind of money they are looking for, what kind of investments they have made, and what they can do. So if you have put any money in the company, you have to reflect it in your balance sheet. You have to show its equity, or you have to show loan from shareholders, which you should be willing to subordinate. Some very important thresholds and steps that one needs to take.
Oh, very good. I've got a question now. I want to jump to John Meyer. So John, you talked about name protection and how incorporating can actually help you with protecting your business name. Would like you to expand upon how that is different from having a trademark. What's the difference between having name protection from incorporating or doing a limited liability corporation and a trademark?
It's a great question, Anita, and you have, certainly a trademark serves the purpose of protecting any trade names or brand marks that you might have out there, and I would strongly encourage any business owner to look at that and pursue that if that's of a necessity to protect some type of intellectual property that you do have. I'm looking at more, let's say I'm joining the call here today from Wilmington, Delaware, and there could be a John's Plumbing LLC, and by having that name at the state level, ability to conduct business under that trade name here in Delaware. Now, if there's somebody else that wanted to try and set up something like that, file some type of doing business as filing, because somebody's operating under that name currently in the state, so there can't be any confusion between those two. So it's another layer of protection. Certainly a trademark can serve as a, I guess, as protection in reserving that name, but forming the entity would also assist you with that. Another thing to think about for small business owners, a lot of folks, if they're franchising a business or if they do have intellectual property, there are certain strategies where individuals will put that trademarks or property, actually maybe patents, into a entity and separate that out from their business activity. Your question there, intellectual property can all be held by a business entity as well.
Okay, very good. And we have time for, let's say, one more quick question and just a wrap up. And so there was a question here, do you need to have a business plan first before working with Biz2 Credit? So Rohit, if you would just address that a little bit more and then wrap us up here, I'd appreciate that.
Yeah, thanks. Yeah, so we actually are very proud to help business owners, especially women business owners, to write a business plan. We have an in-house team of people who can help you to write a business plan, to articulate your business really well. And the other good news is that our business plan is accepted by the lenders, whether they're big lenders, small lenders, SBA lenders, non-SBA lenders. Because what we have seen in our experience, and as Minerva rightly pointed out, if you're a business owner and you are looking for any money from any lender, you need to know your business really well. You need to have that plan, and you need to make other people confident enough that they should be investing money in your business, whether as equity or as debt. And for that, having a good, well-prepared, well-thought only talks about your business, but also about the competitive landscape, and talks about your plan of how you are going to run your business, and especially how you'll use the money that you borrow, and then how you will and how you can repay that money. So that's very important. So, but if you can address all those issues, you will be having a good chance of getting a loan. And we at Biz2Credit can help you write a plan. We can help you to do a free review of your existing business plans, because we have seen that if you have a good business plan, your chances of getting funding goes up dramatically.
Very good. And where do people go if they want to get started on that, Rohit?
So they can actually, go on biz2credit.com, and we have a separate section on business plans. They can call us at our toll-free number. They can, set up a free loan, and set up a free business plan review meetings with us. And so we are here trying to help business owners to start their businesses and expand their businesses, and especially for women, seeing a great track record of them being very creditworthy businesses, and we want to help more and more of them to get access to credit and keep growing.
Thank you. So just go to biz2credit.com, that's biz, B-I-Z, digit 2, credit.com, and if you want to call in, I assume the toll-free number is very prominent on the website as well. Okay, well, thank you all very, very much. We are at the end of our hour, and so we're going to call a close to the webinar. Thank you, Rohit Arora, the CEO of Biz2 Credit, Lisa Cook, economist, Minerva Cote, and John Meyer. It's been a very good sharing of information today, and thank you all for joining in on, and this session has been recorded and will be available archived as well. Thank you all.
Anita, thank you, Rohit. Thank you, everyone.
Thank you. Thank you, Anita.
Thank you.
Thank you, Anita.